Today, the higher for longer camp consolidates. Hello again, it's Martin North from Digital Finance Analytics, one that is post covering finance and property news, and this is our weekly market update. So in a week where central bankers did not lift rates in the US, the UK or Japan, although the ECB did last week, the key message coming through was simple. Expect rates to stay close to current levels for some time, and if inflation does prove stickier, then rates might still need to go higher. But the real action this week was in the bond markets, with yields out along the curve up as prices fell. The Fed's decision was to let its key interest rate stand, but it updated its quarterly summary economic projections to suggest restrictive monetary policy will indeed remain in place longer than previously anticipated. As investors adjusted the Federal Reserve's hawkish outlook revisions, benchmark US Treasury yields hit 16-year highs, although they reversed a little later, as investors turn their focus from hawkish Fed guidance to key economic data waiting in the wings, including the unemployment data. The DXY was at 105.58, with the US dollar maintaining its international strength. The US Treasury market, valued at around $25 trillion US, has witnessed a substantial increase in investments from US households since the Federal Reserve initiated its rate hikes last year. This surge in household holdings from less than $1 trillion to around $2.5 trillion represents the highest level in 25 years, according to Apollo Global Management. The 10-year Treasury yield, a key influencer of the US economy, recently peaked at nearly 4.5%. That's the highest since late 2007. And this significantly affected Wall Street, triggering a sell-off in major technology stocks and other rate-sensitive sectors, following hints from the Federal Reserve of potentially maintaining higher policy rates for an extended period. On Friday, the 10-year Treasury did retreat slightly to 4.44%, and the 2-year remained well over 5% at 5.112, having touched 5.2% earlier in the week. And by the way, the 30-year was at 4.529, having been close to 4.6%. These are significant moves compared with rates before the central bank inflation busting campaign started. Despite minor falls to yields, equities faced substantial weekly losses, with the consumer discretionary segment of the S&P 500 down about 5% across the week, indicating investor apprehension that companies offering non-essential items such as luxury goods, vehicles and vacations could be impacted by an economic slowdown. And on Friday, remarks from Fed Governor Michelle Bowman supported the FOMC hawks, suggesting the Fed funds target rate should be raised further and held, quote, at a restrictive level for some time to bring inflation down to the central bank's 2% target. So as a result, Wall Street seesawed to a lower close on Friday, capping a pretty tumultuous week, during which on Thursday the S&P 500 dipped below its 100-day moving average. That's a key support level for the first time since March. Its failure to break above that level suggests the index is still under downward pressure. So all three indices posted weekly losses, with the S&P 500 and the Nasdaq registering their largest Friday-to-Friday percentage drops since March. This week is about some Fed messaging colliding with overly optimistic equity investors, said Zachary Hill, head of portfolio management at Horizon Investments. Hill added that investors have wanted to trade peak interest rates for almost a year now, but he said it was clear in remarks this week by Fed Chair Jerome Powell and in the dot plot that the Fed doesn't think we're there yet. This week's stock action has been about digesting that reality. There are lots of factors working against a soft landing, and that's something the Fed needs to be reminded of, because pushing rates higher could push us into recession, said Robert Pavick, senior portfolio manager at Dakota Wealth. So the Dow Jones Industrial Average fell 0.31% to 33,963. The S&P 500 lost 0.23% to 4,320, and the Nasdaq Composite dropped 0.09% to 13,211. Among the 11 major sectors of the S&P 500, consumer discretionary suffered the steepest percentage loss, while tech and energy were the only gainers. Ford Motor Company gained 1.9% after the striking United Auto Workers Union reported progress in talks with the automaker, although there were also discussions about widening the industrial action. Activision Blizzard added 1.7% in the wake of Britain's antitrust regulator's statement that Microsoft Corporation's restructured $69 billion acquisition of the company opened the doors to the biggest ever gaming deal being cleared. And US listed shares of Chinese firms including PDD Holdings, JD.com, LI Auto and Bandu rose between 2 and 4% on signs of an economic rebound in China, while Alibaba jumped 5% after Bloomberg reported that the company's logistic arm Canio was planning to file for a Hong Kong IPO as soon as next week. Shares in Tesla and Amazon, both part of this year's Magnificent Seven group of high-performing stocks, also suffered losses this week. Tesla's shares fell around 7%, while Amazon's shares decreased by 6.7%. Increasing borrowing costs pose a risk not only to consumers but also to large corporations needing to repay significant debts in the upcoming years, and consequently, older securities with lower coupons are now seen as less valuable. Many investors are on the wrong side of the bond trade, actually, caught out by these rising yields, which have erased annual gains across a wide section of the bond market. For example, the benchmark Bloomberg US Aggregate Index is forecast to yield a minus 0.6% return this year and a minus 14.4% return over a 3-year period. And the iShares Core US Aggregate Bond ETF was down 2.1% for the year through Friday. Oil prices continue to advance on Friday, though, closing at an 11-week gain. That's over the past 13 weeks. And it's up 35% since the end of June. Notably, Brent crude was up 0.5% on the day to $93.60 a barrel, while WTI climbed to $90.33. The relentless and inflation-inducing rally follows a combination of factors, including recent supply cuts from the OPEC group and its allies, China's recovery from the COVID-19 pandemic in 2022, and a resilient US economy driven by solid consumer spending. In fact, on Wednesday, Morgan Stanley hiked its quarterly forecast for Brent oil prices for 2023 and 2024, citing a supply deficit triggered by the recent extension of production cuts from Saudi Arabia and Russia. The bank believes the shortage will keep oil prices around the current levels, while a move beyond $100 US a barrel, as some predicted, would seem, quote, stretched. The last time US crude oil prices were trading above $100 a barrel was over a year ago, fueling inflation levels to 4-decade highs. In contrast to Morgan Stanley's view, Chevron CEO Mike Wirth was more convinced that crude prices could soar to triple digits in the coming months, mainly due to growing supply constraints. Supply is tightening, inventories are drawing. These things happen gradually, and you can see it building, and so I think the trend would suggest that we're certainly on our way, he said. And he also warned that a jump towards $100 could cause a drag on the US economy. However, he added that the harm would not be very significant. Now, over in Europe, European shares closed lower on Friday, logging sharp weekly losses as investors grapple with the prospect of global interest rates remaining elevated for longer. The Pan-European Stoxx 600 index fell 0.3%, touching its lowest in more than a week, with the construction and materials sector among the top decliners, both down around 1%. Europe's benchmark SOG index notched a weekly decline of 1.9% as investors turned risk-averse after major central banks across the world, including the US Federal Reserve and the Bank of England, hinted at keeping borrowing costs higher for longer than expected. Jitters about an economic slowdown in the Eurozone persisted after preliminary data showed a contraction in economic activity in France and Germany, while a reading of the broader bloc showed the continental economy is likely to contract this quarter and won't return to growth anytime soon. Clearly, the medicine is working. High rates are starting to feed through to the economy, said HSBC economists in the note. With limited fears of a recession, at least a major one, and resurgent energy prices, we think that for now the European Central Bank will remain more focused on tackling inflation and so maintaining its hawkish bias. And in the UK, official figures show that British retail sales partially recovered in August after a rainy July washout, while a separate reading showed the economy displayed clear recession signals. Eurozone banks dipped 1.4% as Dutch bank ING Group and ABN AMRO fell 6.4% and 4.5% respectively after Dutch lawmakers backed a higher tax on banks to cover an increase in the minimum wage and larger childcare support in 2024. That said, helping to limit losses, energy and mining firms rose 0.3% each, tracking rising commodity prices. Technology stocks added 0.8% on Friday, though they logged a weekly decline of close to 2%. And meanwhile, Spain's gross domestic product grew 0.5% in the second quarter, the National Statistics Institute said, as it revised its July estimates up from 0.4% growth. The FTSE in London ended at 7,683, and the CAC 40 in France was at 7,184. Among individual stocks, AstraZeneca gained 1.5% after the London-listed drug maker said its experimental precision drug had slowed the progression of breast cancer in a late-stage trial. Shares of eBay-backed online classified ads Adventure jumped 26.5% after the Norwegian company said it had received a takeover proposal from a consortium led by Premier and Blackstone. Now, over in Asia, most Asian stocks moved in a flat to low range on Friday as markets continued to fret over rising interest rates, while Japan's Nikkei trimmed some early losses after the Bank of Japan offered no changes to its ultra-dovish policy. Regional markets were still reeling from a more hawkish than expected tone struck by the Federal Reserve this week, as the central bank warned that interest rates will remain high for longer. And of course, the European Central Bank and the Bank of England also offered similar warnings, denting risk-driven assets across the globe. Higher rates limit the flow of foreign capital into Asia, presenting a weak outlook for local equities. The Nikkei 225 index traded around 0.6% lower after falling as low as much as 1% earlier on Friday. And the Bank of Japan kept rates at negative levels and said it will continue to support the current pace of stimulus, disappointing some investors hoping for some hawkish signals. And in fact, the governor is now in focus, given he'd said in a recent interview that the bank had enough information to consider a pivot away from negative interest rates. And those comments came amid some growth in Japanese wages, while inflation remained hot, with data on Friday showing that Japanese consumer price index inflation grew slightly more than expected in August, while a core reading remained at a 40-year high. A pivot by the Bank of Japan will mark an end to nearly a decade of easy monetary policy enjoyed by Japanese stocks, and is also likely to send ripples across broader markets, but not yet. And preliminary data released on Friday also showed that Japan's manufacturing sector slowed again in September, and the yen was at 148.38 against the US dollar, suggesting the Bank of Japan will need to lift rates sometime soon. South Korea's Kospi lost 0.27%, while India's Nifty 50 plummeted from record highs earlier in the week. Sentiment towards the Nifty was also battered by a worsening diplomatic spat between India and Canada over the alleged killing of a Sikh secessionist leader. Chinese stocks are among the few outliers of the day, with the Shanghai Composite up 1.55%. And Hong Kong's Hang Seng jumped 2.6% as Hong Kong CEO John Lee Kao-hui said that the government was set to unlock more liquidity measures to boost local stocks. But Chinese markets were still trading lower for the week, hit by growing impatience over more stimulus measures from Beijing. And the People's Bank kept its loan prime rates on hold as expected later in the week. So the yuan was at 7.2985 against the US dollar. The Australian share market did edge higher on Friday, ending a 4-day losing streak after a rebound in energy and mining stocks offset an early loss, but was down 2.9% across the week and it ended at 7,068. Out of the 11 sectors of the ASX 200 index, 5 retreated, with tech and property leading losses on fears that high interest rates would remain in place for months to come. Energy stocks started the session sharply low but regained their footing on stronger oil prices, so Santos rose 0.7% to $7.64, Woodside Energy added 0.6% to $36.25, and Beach Energy edged up 0.3% to $1.625. Origin rallied 1.8% to $8.86. And meanwhile, labour unions and Chevron agreed a deal, spelling the end to more than 2 weeks of work stoppages that threatened to disrupt LNG exports from Western Australia. Minor Rio Tinto shaved 1.1% to 114.57, while BHP firmed 0.5% to 44.34 as iron ore prices in Singapore bounced nearly 0.89% to 121.97. Fortescue jumped 1.5% to $20.81. Fruit and vegetable processor Costa Group were among the best performers on the main index, rallying 6.6% to $3.09 after accepting a $3.20 cash per share takeover offer by US buyout company Payne Schwartz Partners. It was also a good day for media giant News Corp, which rallied 2.2% to $30.36 following news that Rupert Murdoch will step aside as chairman. In other corporate news, pathology group Australia Clinical Labs rose 0.7% to $2.81, even as the competition watchdog said it required more information about its planned merger with Helios. Helios shares finished little changed at $2.37. Treasury Wine Estates rose 2.6% to $12.05. Corporate advisory company E&P Capital estimated that a potential resolution on China's tariffs on Australians' wine, flagged in China's Global Times, will be positive for the company, so E&P set a price target of $12.93. Banks were lower this week, with CBA last at $100.06, ANZ at $25.03, NAB at $28.88 and Westpac at $21.14, while Macquarie was last at $169.50. And the 2-year Aussie bond was last at 4.074, while the 10-year was at 4.356, reflecting the higher for longer mantra, and the Aussie was at 64.42 against the US dollar and 52.63 against the pound. Bitcoin was lolling around 26,600, having moved higher in the week, and the future direction remains as much as a mystery as ever, with some still spruiking hard while others are talking about a sub 20,000 US target. So who knows? And standing back, this week is all about higher bond rates and higher for longer interest rates. And this is true in Australia as it is in other places as well, which means, of course, mortgages are going to stay higher for longer, putting more pressure on households and businesses. And the central banks are not going to be able to take rates lower as the markets were expecting. As yet, this has got to fully sink in, I think, so I wouldn't be surprised to see more market falls in the next few weeks as higher for longer really starts to hit home. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.